If you own Nvidia, Microsoft, Google, or any AI ETF right now, there is a number you need to see. The bond market is already pricing in something the stock market is refusing to admit. And the gap between those two signals is where the real risk lives. I am not here to tell you AI is fake. The technology is real, the demand is genuine, but here's the part most investors are getting wrong right now. The technology can be right, and the trade can still be wrong. That sentence has been true 4 times in the last 200 years. Canals, railways, electrification, the internet, every single time the technology transformed the world. And investors who bought at the peak still lost 70 to 85% of their money. Today, we are going to show you whether AI is setting up that same pattern, how AI risk moves from your tech stocks into your bond funds and retirement portfolio without you noticing, and 3 concrete scenarios for how this plays out. I'm Phoebe with Trading Key. Last episode, we covered the 4 hidden financial risks inside the AI boom. Today, we go further. The pattern nobody wants to see. The Bank for International Settlements compared this AI cycle to 4 specific historical episodes. The pattern is uncomfortable. First came the canal boom of the 1830s. Steam power cut coal transport costs 80%. Real technology. But companies dug canals everywhere, including places with no freight demand. When railways arrived, canal assets collapsed. Banks failed. The global recession of 1839 followed. Then came British railway mania in the 1840s. Railways genuinely changed the economy, but capital poured in faster than revenue could support. By 1847, railway stocks had crashed roughly 85%. The technology worked, the investment did not. Then came electrification in the late 1920s. Electricity was not hype, but Wall Street priced the electrical age as if profits would rise forever. Capacity expanded faster than demand. We know what came next in 1929. Then came the dot-com and telecom bubble. Trillions poured into internet infrastructure. Companies buried fiber optic cable across continents. By 2001, roughly 85% of that fiber sat completely unused. Debt plus depreciation crushed balance sheets. WorldCom went bankrupt. The Nasdaq lost 78%. So the playbook is clear. Real breakthrough, capital flooding in faster than it can be monetized, overbuilding, demand falling short, collapse. But AI is not simply a replay. 3 real differences change the calculus. Demand visibility is better today. Microsoft, Google, and Amazon are sitting on hundreds of billions in signed cloud contracts, not pure analyst guesswork. The balance sheets are stronger. Alphabet posted roughly $132 billion in net income in 2025. These giants will not go bankrupt, though that does not mean their stocks cannot fall 50%. And most importantly, AI can generate its own new demand. Every model improvement unlocks new applications. More applications drive more usage drives more compute. That self-reinforcing flywheel never existed in any previous bubble. The number that should disturb you. Before we get to the systemic picture, stop here, because this one case study is the moment in this video that deserves your full attention. Oracle issued bonds in September 2025. Orders came in 5 times oversubscribed, $90 billion chasing $18 billion in supply. The market was screaming buy. Everyone wanted in. 3 months later, those same investors had lost $1.35 billion. Oracle's credit default swap spread, the cost of insuring against Oracle defaulting on its debt, jumped from around 40 basis points in mid-2025 to 198 basis points by March 2026. Nearly 4 times the level seen during the 2008 financial crisis, an all-time record. S&P and Moody's have both turned negative on Oracle's credit outlook. The most sophisticated bond investors in the world bought in September and got the credit wrong by miles in just 90 days. If the bond market can misprice Oracle that badly, what else is it mispricing right now? Broader tech credit default swap volumes are up 90% since September 2025. The credit market is sending a signal. The equity market has not fully processed it yet. That divergence is where the danger lives. How tech risk becomes your problem. A pure tech correction is painful but manageable. This cycle is more serious because AI risk can spread through 4 channels. The first channel is the equity market and the wealth effect. The Magnificent Seven now represent roughly 34% of the S&P 500. American households hold about 45.76% of their financial assets in equities, compared to just 19 to 27% at the dot-com peak. If AI stocks correct hard, household wealth shrinks, consumer spending pulls back, and the pressure spreads from tech into the broader economy. The second channel is public credit. AI-linked corporate bonds now make up nearly 14% of JPMorgan's entire investment-grade bond index, bigger than the banking sector. Corporate debt spreads sit at just 77 basis points above the risk-free rate, the tightest since 1998. The market is pricing in almost zero risk. When that reprices, borrowing costs rise across the board simultaneously. The third channel is private credit and the shadow system. Much of the AI-linked private lending has no hard collateral. It is underwritten purely on projected future AI profits. Direct lending funds have roughly 15% of portfolios in AI and technology. That chain runs through banks, insurers, and business development companies directly into retail retirement accounts. Unlike banks, these institutions have no central bank backstop. Most retail investors do not know this exposure exists inside their portfolios. The fourth channel is depreciation and accounting opacity. Cash leaves today, depreciation hits earnings later. The biggest pressure arrives between 2027 and 2029. Michael Burry has argued that hyperscalers may be understating depreciation by using useful life assumptions too long for fast-changing Nvidia hardware, estimating a $176 billion understatement from 2026 to 2028 across major AI spenders. Reported earnings today may look cleaner than the underlying economics. Investors may get better visibility only after the wave has already hit. Bonds are warning, stocks are arguing. So why has the market not crashed? Because different parts of the market are sending different signals. The 5 largest hyperscalers issued about $121 billion in investment-grade bonds in 2025, 4.3 times their annual average from 2020 to 2024. New issue concessions for AI debt averaged 12 basis points versus 2.5 for the broader market. High-yield tech spreads have widened roughly 130 basis points relative to broader high yield since January 2026. The bond market is cautious and asking for more premium. The equity market is telling a different story. After Q1 2026 earnings, Alphabet hit new highs on real Google Cloud revenue. Meta posted 33% revenue growth, the fastest of any hyperscaler, and the stock still fell over 7% because free cash flow is visibly compressed and the market will not pay a premium multiple for that. SaaS stocks fell roughly 30% between October 2025 and February 2026. The blanket AI rally is over. Bond markets led. Equity markets are beginning to follow, selectively. Corporate spreads still sit at 1997, era lows even as AI debt hits record highs. That gap is why any repricing could hit harder than most people expect. What happens next? There are 3 realistic paths from here. The base case is a rolling repricing with a 40 to 50% probability. No crash, no repeat of 2000. Depreciation pressure rises in 2027 and 2028. Earnings growth slows. AI stocks face multiple compression. Real revenue keeps growing, but takes time to close the gap with CapEx. The market grinds, it does not collapse. For investors, the move is to rotate away from companies whose only story is, we spent the most on AI, and toward companies with visible cash flow. Google Cloud, AWS, usage-based platforms, software with measurable customer ROI. The tail risk scenario is lower probability but far more painful, with a 15 to 20% probability. The circular funding chain breaks. AI startups cannot raise at current valuations. Compute commitments go unfulfilled. Cloud revenue expectations get cut, credit spreads spike. Private credit faces a liquidity wave. Drawdowns of 50 to 70% on overvalued names are entirely possible. In this scenario, cash matters, short duration treasuries matter, and checking your indirect private credit exposure is not optional. One more thing, do not assume the first significant drop is the bottom. In 2000, the Nasdaq fell over 3 years with multiple false rallies along the way. The bullish AI flywheel is the scenario the bulls are genuinely right to watch, with a 30 to 40% probability. AI agents and enterprise tools move into large-scale deployment in 2026 and 2027. Companies across healthcare, manufacturing, fintech, and legal start paying real money for measurable AI outcomes. Revenue grows faster than depreciation. Then the CapEx looks justified. The leading platforms get re-rated higher. This is real. AI has a self-reinforcing demand loop that Canals, railways, and fiber never had. But even in this scenario, not every AI stock wins. The better opportunities shift toward the application layer, companies that use AI to create measurable return on investment for their customers. Proven cash flow or hope. The BIS put AI on the same list as global inflation and financial instability, not because AI is fake. Because when everyone is right about the technology and wrong about the price, that is exactly when the most money gets lost. 4 things are true regardless of which scenario plays out. The risk is real, only timing and scale are unknown. This will not look like a banking crisis, but multi-year valuation compression is very much on the table for the wrong names. The divergence has already started, with bond markets leading and equities beginning to follow. And being right about AI is no longer enough. You need to be right about which company captures the value, at what price, and on what timeline. So here is the question worth sitting with before you close this video. Look at whatever AI position you hold right now, and ask yourself honestly, am I paying for proven AI cash flow, or am I paying for the hope that the cash flow arrives before the depreciation does? So which scenario do you think we are heading into? A grinding correction or a longer AI bull run? Tell me in the comments. Subscribe to Trading Key for more breakdowns like this. See you in the next one.